So in this video, I'm going to provide you actual data and actual statistics on the stock market and some prior crashes that we've had. And you can decide for yourself whether the data actually shows there's good times ahead or, if this is all doom and gloom like the media is trying to portray this to be. I will also share my thoughts at the end of this video if you're interested. But either way, if you find any value in this video, hit the like button to help send this out to more people. So there's a few things I want to cover. First is going to be talking about the Fed rate hikes because that's a hot topic. I'll also be discussing some midterm election data that I found. And then I'll also share with you some other random statistics that I came across, like technical analysis, like some other capitulation metrics, like fear and greed. There's quite a bit we're going to discuss in this video. So if you have to, pause at any point, look at the data, and then resume the video, rewatch it a couple times if that's what it takes to stick. So let's start us off with the most relevant data here, in my opinion, which is around Fed rate hikes. Okay, so here we can see some data around the rate hikes and the S&P 500 specifically. Now, as we can see, for the months preceding the first rate hike, which is the period that we're at right now there's a heavy focus on valuation and value stocks, and growth and momentum plays tend to get hurt and tend to be out of favor. This, guys, is exactly what we have been seeing so far in the market. Growth stocks, anything with growth in its name and future projections, they are not what investors want to buy today. They want to stick to the tried and true value plays right now based on their future cash flows and reasonable valuations. Now, the S&P also returns usually around 5% or so before the first hike usually. Now, what's interesting is that after the first hike takes place, we generally see the index first decline the first few months, 3 months or so, but then 6 months later, things turn positive. There's a high focus once again placed on valuations, and growth tends to also make a comeback here and eventually does become a favorable investment once again around that 6-month mark. So what this data is really telling us is that typically, after the first hike is really put into effect, the S&P kind of throws a tantrum, stocks decline across the board, but then eventually things level out, and then 6 months out from the first hike, things look a lot better and we're back up in the green. Now, obviously, this is just a general statistic. It's not always going to be the case. In fact, right now, we haven't seen the first hike yet, but we're down, quite a bit in the markets already. So it's always important to understand that stats are just kind of approximations. It doesn't necessarily mean things are going to play out exactly that way. Now, another chart I want to share is this, and I apologize for the blurriness here, but essentially this shows the typical rate hike cycle start and end date, and we can see on average during the whole cycle of the Fed raising interest rates, the market has phenomenal returns, with the NASDAQ actually seeing the best of the 3 indexes. Okay, so that's kind of the data so far, and you're probably thinking, you know what, Nick, that looks interesting, but this year we're going to have 4 rate hikes potentially. So, this could be something much worse than what we've seen before. So interesting enough, I actually came across some data online which kind of shows us the returns of the S&P 500 on years that we see 4 or more rate hikes. So there's been 9 years in recent times that I've seen 4+ rate hikes in a single year, and these were the returns from the S&P 500 for these years. And on average, you can see we get a return of around 8.1% during these years. So all of this data so far is actually very bullish. And what it's telling us is that, contrary to popular belief in the media, rate hikes actually are good for the overall stock market, and stocks over time do quite well in rate hike cycles. Okay, so rate hikes is just one major factor here in 2022. The other is going to happen towards the later part of this year, and that's going to be the midterms. Here we can see the maximum drawdown for the S&P 500 seen in a 3-month period during the midterm year, which is what we're in right now in 2022. And what this shows us is that on average, we see a 16% decline during these years. And virtually every single time we have a midterm, that year we see quite a bit of selling pressure at some point. Now, for reference, since the beginning of January, the S&P has declined around 8.7% peak to trough. So we're only about halfway through what the average decline of around 16%. Also, this all happened in 1 month. The average we saw shows us a 3-month period. So, we still have time for this stat to once again prove true. So we can see the data is telling us here with the midterms that in a year that we have midterms like 2022, you are going to see declines, and they are typically pretty sharp declines. And so far, it's looking like it's going to be another year of a sharp decline. Combine that with, some short-term pressure with rate hikes. Yeah, you have a recipe for some selling. But then the good news, guys, is that, with the rate hikes at least, longer term, 6 months out, it tends to be pretty good for the stock market. So we'll see if these stats kind of hold up once again. The next I want to share with you here is a capitulation index I came across on Twitter. And we can see that generally during market drawdowns, we typically fall much further on this graph. So this tells me that there's probably quite a bit more selling to come, which coincides with the previous data points we looked at. Now the fear greed index also shows that we're kind of neutral currently, close to around a 50 actually, and we still have quite a ways to go before true fear is felt in the markets like we saw back in 2020 March. So those are the data points I really wanted to get across to you. Subjectively, just data points I found on the internet, not my opinions. And if that's all you came for, I hope you enjoyed this video. Hit the like button on your way out. But if you want to hear my thoughts now, stay tuned. So I think personally that we're still, like the data says, around halfway through the pain here. And coincidentally, we have earnings season just beginning right now. And if Netflix was any indicator, there is going to be some pain this earnings season, especially for stocks that don't necessarily meet their guidance and outlook. This could most definitely send us lower in the short term, pull the indexes down, and could see the S&P correcting around 15 to 20%. And the NASDAQ, which is typically more volatile, probably going to correct around, 20 to 30% or so. This is, of course, all just speculative thinking, guys, so don't take this as like Nick said it, so let's see if it's true and let's see how right he is on this. I'm just speculating here, and I recognize that. Now, I do follow technical charts quite a bit, and we can see here that based on the past 2 crashes that we've seen, they both bottomed around the 200 moving average on the weekly here, and this is for the QQQ, which is the NASDAQ. So right now, we're still quite a ways off of that. We've reached the first line of support, which is that 50 moving average. The next line of support will be the 100 moving average, and then after that, if we break that quite strongly, that 200 moving average will most likely be tested. So keep an eye on this too. So, based on what I'm seeing, based on the data that I've come across and what I've shared with you guys, I think there's still some more pain ahead. I think that we're not going to see a bottom for, a few more weeks. But, waiting for an actual bottom and trying to buy in at the bottom is a losing game. It's virtually impossible to buy stocks at the bottom. When we do bottom out, we're probably going to see a sharp, aggressive rally back up. And if you're waiting for a bottom, you're probably going to miss out on that rally, and you're probably going to miss out on some good gains on the way back up. I saw this happen during March 2020. You've seen this happen plenty of times in previous crashes. People just wait for the bottom, wait for the bottom, wait for the bottom, and then when the bottom comes, they're like, oh, it's going to go even lower. They miss the bottom, it goes higher, and then, the cycle repeats again. They're like, oh, I'm just going to wait for the next crash. Personally, what I do is I just consistently start buying in once I see the stocks I want to buy are on sale. Now, on sale doesn't necessarily mean they're just off their highs. I look at their valuations, I look at their metrics, and I'm like, okay, this looks cheap for this stock and how much money it produces, its balance sheet, its outlook, its growth, all that kind of stuff. So then, after a certain point, I'm like, anything below this, I'll buy, and I just keep averaging in, every few days, every few weeks, and build up my position that way. I cash the bottom, great. If I don't, I still have a good cost basis. Everyone's happy. I know there's going to be some of you that comment down below and you're like, oh, you're just cashing a falling knife. It doesn't make any sense to buy in right now if things are going lower, especially if you think things are going lower. And like I said, it's speculation on, guessing if things are going to go lower or not. All I know is that there are stocks out there that show value today, and that's what I'm putting my money in. And those are the investments I think will return me some good gains over the next 3 to 5 years. I don't care about cash in the bottom as long as I'm getting good value for my buys. Remember, at any given time during the stock market, there has been plenty of reasons to sell, to cash out, and try to time the bottom. And guess what? Most of the time people miss the bottom. And every single time the market has bottomed and recovered and made new highs despite all the fear and the reasons out there to sell. Is this time going to be any different? Absolutely not. That's just my opinion, but I don't think it's going to be any different this time. Maybe we enter a prolonged period of selling, bear market, that kind of stuff. But eventually, if you have a long enough time horizon, good companies will recover, indexes will recover, and your portfolios, hopefully if you pick the right companies, will recover as well. Be selective, don't just go out there and buy junk. Be mindful on what you're purchasing, because that will determine your future returns and essentially your future financial position, which can either make or break you, 5-10 years out. Anyways, guys, thank you so much for watching. Hope you enjoyed this video, and if you did, again, hit the like button, share this with a friend, and subscribe if you're brand new here as well. Anyways, guys, that's it from me. There'll be more videos coming out this week, so stay tuned. Thanks so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.